with the One Big Beautiful Bill Act being passed and real estate investors get bonus depreciation.
That's game changing.
That is a game changer.
Are you wondering how the One Big Beautiful tax plan going to affect you as a real estate investor? Do you want to save on your tax liability? Well, lucky for you, today I have Geraldine Serrano back for the second time from STG Tax Specialty, and she's going to go over the whole plan.
Yeah, so a lot of investors were waiting to see if that One Big Beautiful Bill Act got passed, and it did back in July. And so real estate investors are super happy because what they were waiting to see come back is the 100% bonus depreciation. So they already get a tax break by using the tax strategy cost segregation on their real estate investments. But after the 100% bonus depreciation started to decrease by 20% starting in 2023, and then it went down to 60% last year and then 40% this year, when that bill got passed and brought 100% back, then the investors are happy that they can get 100% of the additional depreciation they get with a cost segregation study. So they're super happy. And a lot of them purposely went on extension to see if that 100% bonus came back, and it did. So that's why real estate investors are so happy and are buying real estate.
So Geraldine, let me talk about that one. So you're saying what happened before July 1st was we had about 60% this year, right? Of depreciation.
40.
So 40% after this bill was passed. So you're basically telling me after July 1st, let's say in August, I bought $1 million property. I did a cost segregation study with yourself, and your company came and did a study and said, Jack, of this $1 million property, 30% of it is roughly about 30%.
Sure.
Can be accelerated. When we say accelerated, so in a commercial property, the depreciation period is 39 and a half years, correct? And residential is 27 and a half years.
Right. So residential is on a 27 and a half year schedule, and commercial properties are on a 39-year schedule.
So that property that I bought for $1 million, it would be depreciated over 39 and a half years. But with this study, 30% of that cost or that depreciation I can accelerate in this year of owning it.
Correct. If you got 30% of the study.
If I got 30% of the study.
Right.
Let's say, okay, so 30% of $1 million is $300,000.
Correct.
And before July 1st, I was able to get 40% of that.
Well, so this year, without that bill being passed, starting January 1st, so for this year, if you've purchased or newly constructed a property, you got 40% bonus depreciation. But with that bill being passed, unfortunately, it didn't start on January 1st, but you get 40% if you've purchased or newly constructed a property anywhere between January 1st to January 19th. January 20th of this year and beyond, you get 100% bonus depreciation.
So that's game changing.
That is a game changer. All of these investors are super happy, and it's going to impact the real estate market, right? Because real estate investors that have a huge tax liability are, and that need the 100% bonus, right? That they're going to want to buy real estate. We just got past the October deadline. My team and I are going to still be slammed by the end of the year, because for those real estate investors that know that they're going to owe for 2025, they're going to want to make sure they close on their real estate investment by December 31st of 2025. Right now, I'm already getting calls from real estate investors, like this real estate investor in San Diego. His CPA told him, you're going to owe $1 million in taxes for 2025. So you need to buy some real estate. So he is about to close on a property in Temecula, and it's going to get him, possibly 100,000 in additional depreciation. Well, if he wants to wipe out that $100 million tax liabilities, he's got to buy way more properties or higher price properties to be able to wipe out that $1 million tax liability.
Okay. So anyone that's watching and has purchased a property post January 19th and are worried they might have a big tax bill for the 2025, we got to call Geraldine.
You got to call
Or you got to do a
Geraldine.
cost. You got to learn about cost segregation.
Right. Let's talk about that same investor. And he did ask me this question. He bought a single family home in Temecula and for $1 million. And I said that we're estimating he could get about a little bit over 100,000 in accelerated depreciation. Well, that's not, he needs to get to $1 million to offset what he owes in taxes. So and this is not unusual. He's now looking at buying a unit in Mammoth and doing Airbnb with it. And he's going to pick that up for $1 million. And he's potentially going to get significantly more depreciation with that condo. Do you know why?
Why?
Because when you buy property, unless it's a condo or straight land, you're typically buying two things. So with that single family home in Temecula, he's buying the building and he's buying the land.
Correct.
The building's depreciable, not the land. So we're only looking at the building. Well, for a condo, unless you have like a parking space, there's some land involved, then the entire $1 million is the depreciable basis. So if there's no land taken out of it, right? And let's go back to your example about 30%. Well, 30% of $1 million is 300,000. So he's getting way more tax benefit and by doing a cost segregation study on that unit versus the single family home that he bought for $1 million out in Temecula.
Wow. Because it's a condo and there's no, wow. Okay.
And the same applies if that was a commercial property. Let's just say he bought a commercial building in Temecula for $1 million. It's still the same numbers, right? And even if he were to buy a commercial condo in Mammoth, it's still the same application, right? The commercial building in Temecula, land's still going to need to be taken out of it. You buy a commercial condo to be used as an office in Mammoth. There's still, like I said, as long as there's no land that's involved with that purchase price, you're still looking at the 300,000, regardless if it's residential or commercial.
I love when you come on the podcast. I always learn something new. Something new I can teach my clients or someone watching here. So that's good to know. Though that's one of the big things that came off of this bill. You were telling me something else about research and development. If you're an owner in manufacturing or own a warehouse that you create stuff. What was that? That was a big one.
So the benefit for manufacturers that are newly constructing a building for their manufacturing business or purchasing a property and renovating it for their manufacturing business, they get a bigger tax break. They get 100% bonus depreciation on the entire building. That is huge. And they don't need to do a cost segregation study. So that's huge for them. So manufacturers that want that big tax break are going to be either newly constructing a building or they're going to buy an existing building and doing heavy renovation to take advantage of that.
So these semiconductor companies that are opening foundries in Arizona, that qualifies, right? So these guys are going to get billions of dollars in deduction.
Yeah, so they're going to get a huge tax break just off of the building, whether they newly construct it or buy a building and renovate it. But to go back to your question about what I was telling you about the R&D tax credit, the benefit that those manufacturers are getting with the R&D is with the bill being passed, they get to amend their 2020 their tax returns between 2022, 2023, and 2024 to get a refund. Because before that bill got passed, they had to capitalize and amortize their R&D expenses over 5 years. So just like the 100% bonus, they didn't get it all up front. So that's huge. And then the second benefit that they're getting is in 2025, they get to immediately deduct all their R&D expenses. They don't have to capitalize and amortize it over 5 years. So those manufacturers, they're getting huge tax breaks with, the being able to depreciate the entire building, getting the 100% bonus depreciation on the building, and then getting the tax break on the R&D tax credit.
So on a smaller scale, um, when you talk about manufacturers, can you give me a couple examples of if someone's watching that owns a clothing, like they manufacture clothing or something they sell on Amazon? Are those, do they qualify for this tax credit?
If they're selling clothes on Amazon?
If they're selling clothes on Amazon, or if they're let's just say they're manufacturing toys they have a warehouse in San Bernardino, do they qualify for something like this, or does it have to be actually something where you're doing research and development?
So it has to be something that you're doing research and development. So the R&D tax credit is for companies that are creating or improving a product or service. So let's take that. So with toys, right? If those toys somehow, I know the big thing right now is AI. Let's say they had a toy, right? And somehow it replaced, let's say, the school teacher, right? That's what we're all worried about. Like, what jobs is AI going to replace, right? So if they created a toy where the child didn't even have to go to school because they're learning from this toy that's trained to teach their kid, I mean, then that may qualify for the R&D tax credit, right? But, with the R&D tax credit, there has to be a certain level of uncertainty and experimentation, right? It can't be like, oh, you bought Legos, because there's Legos have been around for a long time, and it's not something new being developed, right? This has to be something that they're doing, like what you said, Jack. There has to be some element of research and development with whatever they're creating or improving.
Okay. So let me bring it back to cost segregation then, because that one, I don't know if we have many viewers that are in research and development, but I know we have a lot of property owners watching this. So if we go back to cost segregation study, when does it make sense for an investor to do it? I know, is it before acquisition? I mean, like when you do purchase it and want to do the renovation, or after renovation, or during the renovation?
So good question. The best time to do a cost segregation study is right after purchase. And the reason for that is if you were to do it later, then there's going to be more work involved. You would have to submit an IRS form called the 3115. Let's say you've owned a building for a year, right? So it's already on your tax return. So if you were to use a cost segregation study after a year, then you'd have to submit that IRS form 3115, telling the IRS you're going to change depreciation methods. And then you'd have to submit these, both the federal and state 481 calculations, telling the IRS that you took that year of depreciation and how much accelerated depreciation you're taking now. And also, a lot of investors purchase property. Let's say they purchase a multifamily building. They purchase those type of properties with the intent to renovate the units so that they can increase the rents. So that in that scenario, depending on the timing of when you do the renovation, you might consider doing a two-part study because you're going to want to capture the accelerated depreciation from the building as is, and then you're going to want to capture the accelerated depreciation on the improvements. And then also, the first study would help with something called partial asset dispositions. The IRS says you can write off whatever you throw away, right? So if you're replacing the carpet, the roof, the first study is going to help you get more write-offs.
So the stuff I'm going to throw away, I can get a write-off on it.
Correct.
So there's one man's trash is another man's gold on that point, right? Or
right.
woman.
Okay. Right.
Well, that's pretty cool. I did not know that. So thanks for letting me know. I'll keep that in mind for the next property I buy. When it comes to a cost segregation study, is an asset class more beneficial than another one? Is it, multifamily over retail or over industrial?
Yes.
Okay.
So an example I like to use when I get asked this question is a cost segregation study is literally separating the real property, which the IRS considers permanently attached to the ground, from personal property, right? Which the IRS considers if you wanted to take it with you, you could, right? A perfect example would be cabinets. Would you take cabinets with you? I mean, I would, because right now I could better organize my garage. But So let's take so if we were to look at a warehouse and think about, yeah, and the other example I'd like to use is if you were to turn the building upside down, whatever would fall out is what we would take a look at when we do a cost segregation study. Well, if you were to turn a warehouse upside down, there's nothing in it, right? Because let's say they're just using it for storage. So, we're not going to find much. Now, if you were to take an apartment building and turn it upside down, we're going to find plenty, right? Because you think about what's in an apartment building. We're going to find carpet, cabinets, countertops, wall coverings. There's going to be a lot that we're going to find on the inside. And then outside, land improvements shown on a cost segregation study is going to be depreciated over 15 years. So we're going to take a look outside the building. We're going to look at the asphalt, the landscaping. So, you're going to get plenty on the outside, but typically with a warehouse, you won't find as much as you would on a residential property.
Right. Okay. Good to know. So, I mean, most of the time I've done when I've done cost segregation with you, it's been multifamily, but good to know, because here's my next question. For investors doing a 1031 exchange, what are some key do's and don'ts when trying to think about doing a cost segregation part of their 1031 exchange? Is it help you? Obviously, you answered this question of what kind of property to buy, but um, when would be the best time to combine the cost segregation study with the 1031? Sometimes I hear you can get in trouble with it at the 1031 if you do it and do a cost segregation study, and IRS disallows it. Is that true, or I don't know? I'm kind of wondering.
So, as far as a cost segregation study is concerned, you may consider doing it on both the relinquished property and the new property, but it all depends. So, if the relinquished property is fully depreciated, because I have clients that miss getting that annual depreciation, right? And so they wouldn't do a cost segregation study because the property is fully depreciated. But because they missed the depreciation, and if they need more depreciation, then they would do the cost segregation study on the new property. But let's say they bought apartment building, they owned it for 5 years, right? So there's plenty of depreciation left on that relinquished property, right? So ideally, you would want to do it on that relinquished property and the new property. So the issue that you mentioned, Jack, about how the IRS views 1031 exchanges and personal property and cost segregation, it's just the issue of, if you separate the personal property on the relinquished property, how is that applied with the new property? And, so there's just considerations that the IRS is scrutinizing with a 1031 exchange and what can be carried to the new property. But that's the issue that is that revolves around that type of situation. But as far as a cost seg, then that's what we would be taking a look at is how much depreciation is left on the relinquished property.
So basically what you're saying is, if whoever your CPA or accountant is as an investor, make sure they have your bases correct.
Correct.
Okay. Great topics. Great knowledge drop, Geraldine. I'm going to leave you with the last word. What would you like to say finally? And then please, again, let the audience know if they're interested in cost segregation or learning more, or if they have a property that they want to see qualifies, where can they reach you?
So I want to leave all the real estate investors with this. If you haven't heard about cost segregation and this is your first time hearing it, if you know you're going to owe for 2025, then just like that investor that I'm working with right now, that before the end of the year, you can reach out to me and find out how much you can save on taxes with cost segregation, because it's a great time to buy real estate. With the One Big Beautiful Bill Act being passed and real estate investors get bonus depreciation, I can provide you with a complimentary estimate. My team and I can run some numbers to let you know how much you may be able to save on taxes. So you can reach me at 510-386-0872, or feel free to email me at Geraldine, GERALDINE .Serrano, S as in Sam, ERRAN as in Nancy O, at specialty specialtytaxgroup.com, or if you Google me, I come up as the cost seg queen or the cost seg queen for as the director for Specialty Tax Group. Thank you for listening. And Jack, thank you for having me back on your podcast.
Geraldine, always a pleasure. If you're watching this and you enjoyed this content or would like more, please feel free to like and comment below or subscribe. This helps me bring more content and more interviews like this with people like Geraldine that are helping investors save more money, grow their wealth, and leave a legacy for their family. So until the next show, we'll see you there.